Every Tupperware lid closes with a burp. Press the center, lift one edge, and the air rushes out, a small, deliberate sound that means nothing can get back in. For most of the 20th century, that burp was the most trusted noise in the American kitchen. They told us Tupperware was permanent, a wedding gift, a hand-me-down, a brand so ordinary it became the generic word for everything it competed against. By 2013, the company behind it was worth nearly $5 billion, and the market treated that number as a floor, not a ceiling. The containers, after all, were built to last forever. So was the business. Or so everyone assumed, but the same seal that kept the air out was about to trap something far more dangerous inside. This is the story of how an empire 80 years in the making burned down to a tenth of a cent, and who was holding the match when it did. The seal came first. In 1938, a chemist named Earl Tupper took a waste product from oil refining, a black slag other companies threw away, and turned it into something flexible, clean, and durable. By 1946, he had molded it into bell-shaped containers and given them a lid that locked with a now famous airtight snap. It was a genuine invention. The problem was that nobody wanted to buy it. Tupperware sat on hardware store shelves and did not move, because customers could not understand a lid they had to burp. What saved the company was not the product but a saleswoman. Brownie Wise, a single mother from Detroit, understood that the seal had to be demonstrated, in a living room, by someone they trusted. To prove it worked, she would fill a sealed bowl with water and toss it across the room. Nothing spilled. By 1951, she ran all of Tupperware's sales, and on her advice, the company pulled its products out of stores and sold them only through the party. It worked because it was personal. Sales exploded. But Wise never owned a single share of the company she built. In 1958, after years of friction, Earl Tupper fired her, and she settled her lawsuit for about $30,000. Months later, he sold the whole company to the Rexall drug companies for $16 million and left the country a wealthy man. The woman who built the sales empire left with almost nothing. Remember that. It happens again at the end. That model built the modern empire, and it planted the seed of everything that came after. Tupperware did not sell plastic. It sold a relationship, a Tuesday evening, a reason to host. For decades it worked, and the brand spread across the world until people called every plastic tub by its name, whether it was Tupperware or not. The seal had become a household reflex. By the early 2000s, Tupperware had become something its founder never imagined, a global financial machine. Decades under Rexall and its successors had ended with the brand trading as a public company in its own right. And in 2005, it renamed itself Tupperware Brands to signal it was now more than plastic. It expanded into beauty and personal care, and it pushed the party into markets where it was brand new. In Indonesia, Mexico, and Germany, the living room demonstration that built 1950s America worked all over again. By 2013, Indonesia alone was buying more than $200 million of Tupperware a year, a bigger market than Germany. That was the year the stock peaked. In December of 2013, shares touched $96, valuing the company at nearly $5 billion. Revenue would climb past $2 billion a few years later, carried by a sales force that numbered in the millions across nearly 100 countries. Analysts modeled steady dividends and easy growth. The brand was iconic. The cash flow was real, and the seal still snapped shut exactly the way it had in 1946. Management believed the model was timeless. Why wouldn't they? It had survived television, supermarkets, and 3 recessions. A direct sales empire built on trust did not need a website. The party was the product. And the most important number on the whole income statement, the one nobody flagged, was the average age of the woman hosting it. If you're still watching, you're exactly who this channel is for. Bondholder is new. We're building this from scratch. telling the stories of corporate collapse from the perspective of the people who saw it coming. The creditors. If that's the kind of story you want more of, hit subscribe. You don't just stay in the loop for the next empire that breaks before the headlines do. You help us keep making these. Thank you. But a seal only holds in one direction, and by 2020s the pressure was already on the wrong side. The model that made Tupperware unbeatable had quietly become its single point of failure. A company that sold almost everything through in-person gatherings had no answer when, in 2020, in-person gatherings simply stopped. For one strange quarter, the pandemic actually helped. As lockdown families rediscovered home cooking and leftovers and sales briefly jumped. Then the parties disappeared, and they did not come back. The deeper problem was older than the virus. For 2 decades, the company had watched its sales force age and shrink, while it did almost nothing to reach anyone under 40. Active sellers, the lifeblood of the whole model, fell year after year, sometimes in the double digits, and a long parade of new chief executives, turnaround plans and cost cuts bought motion without progress. The same direct selling machine had been strangling Avon and pressuring Mary Kay over those same years. A generation of customers had moved online, and a brand that refused to meet them there was selling to a room that kept getting emptier. Tupperware arrived late to its own website, late to Amazon, late to a deal to put its products on the shelves of Target. By then, the habit was gone. A seal cannot be demonstrated through a screen. Then the math turned hostile. The plastic resin the containers are molded from is a petroleum product, and after 2020, its price spiked alongside freight and labor. Margins that had survived for decades compressed in a matter of quarters. Management's answer was to raise prices into the teeth of the worst inflation in 40 years, asking shoppers to pay more for premium plastic at the exact moment those shoppers were trading down to store-brand tubs at a fraction of the cost. It was a decision made from inside the bubble. There was a quieter problem too. The containers were so durable they rarely needed replacing. So a brand that had stopped winning younger customers was leaning on older ones who already owned everything they could need. And underneath all of it sat the debt. The company had borrowed heavily, and by 2022 it carried more than $700 million of it. As long as profits flowed, the debt was invisible. When profits stopped, the debt became the only thing that mattered. The containers still sealed perfectly. The balance sheet did not. This is where the people who read the loan documents enter the story, because they had been watching the math break for more than a year before the public caught on. In April of 2023, Tupperware told regulators there was substantial doubt about its ability to continue as a going concern. In plain terms, the company was warning that it might not survive the year, had tripped the limits in its credit agreement, and could no longer draw on its revolving line. The emergency cash that keeps a business breathing between paychecks. For the senior secured lenders, that was the signal. They sat at the very top of the line with the first legal claim on the company's assets, and they could watch the covenants failing in real time. What happened next is the part the headlines missed. That August, the lenders agreed to restructure the debt, reallocating roughly $150 million of cash interest, pushing about $348 million of principal out to 2027, and switching some of it to payment in kind, which let Tupperware pay interest with more debt instead of cash it did not have. In return, it got access to about $21 million more borrowing. It looked like a lifeline. It was really a tightening grip. Each concession bought a little time in exchange for a little more leverage, and over the following year, distressed debt investors quietly bought up that senior paper at a discount. By the time the stock cratered, the loans had already changed hands, often to funds that specialize in exactly this, buying the debt of dying companies cheaply and waiting. The creditors were not betting on a turnaround. They were positioning for the wreckage. Then the strangest chapter began. In the summer of 2023, as the company was warning it might collapse, its stock did the opposite of dying. Retail traders on social media found it. The same crowd that had piled into GameStop and Bed Bath & Beyond piled into Tupperware. And in 10 days, the shares rose more than 500%, leaping from under $1 to over $5. A company on the edge of bankruptcy briefly looked like a winning lottery ticket. For a few weeks, the meme made more noise than the warnings did. None of it was real. The traders were buying a story. The lenders were reading a balance sheet. The fundamentals never blinked. The New York Stock Exchange warned that the stock had traded below $1 for too long, and that filings were overdue. Tupperware missed its annual report. It missed quarterly reports. Its longtime auditor resigned rather than keep signing the books, and the company admitted it had found errors in financial statements it had already published. Weeks before the end, it took on a small emergency loan simply to keep the lights on. Each disclosure was worse than the last. The seal was leaking from every edge at once. By September of 2024, there was nothing left to restructure. Tupperware filed for bankruptcy protection in Delaware, listing as much as $10 billion in liabilities against assets that might not clear $1 billion. And here the creditors made their move. The senior lenders did not want a long, expensive reorganization. They wanted the company's best asset, the Tupperware name itself, and they had the legal standing to take it. They pushed for a fast sale, even a foreclosure, and objected to the company spending its last cash. The business that built the brand and the lenders who now controlled its debt were no longer on the same side. They were fighting over the body before it was cold. An empire that spent 80 years perfecting a seal could not seal its own balance sheet. So what does Tupperware actually prove? Not that the product failed. The product was extraordinary, and it still works. It proves that a great brand and a good business are not the same thing, and that the gap between the two is exactly where creditors live. For 3/4 of a century, Tupperware confused them. It assumed that because everyone knew the name would always be worth something. But brand recognition does not service debt. A household word cannot make a loan payment. The company that sold permanence to its customers had built itself on a model that quietly stopped working, then borrowed against a future that was already shrinking. That is the pattern. And it is older than Tupperware. It carved up Avon. It hollowed out Bed Bath & Beyond. It buried a dozen names no one even remembers. It is the same trap every time. A business mistakes its peak for its baseline, takes on debt to defend the old way of doing things, and learns too late that debt has no nostalgia. The seal is the perfect emblem for it. Tupperware spent decades teaching the world that the whole point was to keep the air out, to protect what was inside from everything outside. But the threat was never outside. It was the slow leak within, the aging sales force, the missed pivot, the borrowing that looked survivable right up until the day it was not. By the time anyone heard the burp, the pressure had already equalized. The container was open, and the only people standing over it with a claim were the ones who had read the fine print years earlier. The fine print won. In November of 2024, a company called Party Products, formed by Tupperware's own secured lenders, bought the brand and its core operations out of bankruptcy. They did not pay cash for it in the ordinary way. They used what is called a credit bid. The lenders were owed so much that they were allowed to swap the debt itself for the assets. The people who held the loans simply took the thing the loans were secured against. They had, in effect, foreclosed on an American institution of 80 years old and walked away owning its name. Everyone below them in line got the leftovers. The court approved a liquidation plan that became effective in June of 2025, leaving a trust to divide whatever was left among the lower-ranked creditors. And the shareholders, the retail traders who had chased the stock to the moon, the long-term holders who had trusted the dividend, the employees who owned a piece of the company they worked for, received nothing. Zero. It was the same lesson Brownie Wise learned in 1958, when she was pushed out of the empire she built without owning a single share. The people who build a company and the people who hold its claims are rarely the same, and only one group is ever in the room when the money is divided. One side read the loan documents. The other read the headlines. Only one of them got paid. The container still closed with that airtight burp. The company is gone. Its name now belongs to the creditors who broke the seal.